Welcome to the deep dive. We focus intensely on one source to pull out the knowledge you need fast.
And today, we're digging into a YouTube video transcript. It's all about the psychology, the emotions behind trading.
Right, so our mission here is pretty clear. Uncover actionable insights for you on handling those mental hurdles in the financial markets.
Yeah, and one of the first things that jumps out is how the speaker tackles the beginner's mindset.
Oh yeah, what specifically?
Well, he says many people starting out are just hunting for these simple, almost magical trading setups. You know, perfect entries, perfect stops.
The gimmicky little 1, 2, 3 setups, I think he calls them. The search for that shortcut.
Exactly. But his whole point is that this search is kind of misplaced. What you really need is a solid foundation, a real understanding of how markets move.
So forget the magic formula, focus on the fundamentals. He actually argues that foundational knowledge is basically all you need for, well, potential success.
That's the core idea. It implies your initial energy shouldn't be spent chasing signals.
But really digging deep into market dynamics first. Build that base.
Precisely. Because that understanding informs everything else.
Okay. Then he shifts gears into something I think many will find familiar, that internal emotional battle.
Ah, yes. The struggle when you see a small profit.
Right. That urge, that almost physical need to just grab it, lock it in, even if your plan was to hold for a bigger move, maybe the whole day's range.
Why is that urge so strong, though? He uses some pretty intense language there.
He does. He talks about feeling nauseous, even getting irritated with family members because of the stress of watching that small profit fluctuate.
Wow. That paints a picture. Getting snappy with loved ones over a tiny paper profit.
It sounds extreme, but maybe relatable. He puts it down to a lack of experience.
And specifically,
A lack of comfort with uncertainty, with just letting price do its thing without freaking out.
so the insight is that emotional trading, that knee-jerk reaction, it stems from being uncomfortable with the inherent randomness or perceived randomness of the market.
And not having that broader context, that deeper understanding we just talked about.
Right. If you don't have that comfort level, every tick feels huge.
Yeah.
Threatening, almost.
And the speaker suggests building that comfort comes from doing the actual work.
A work of anticipating price.
Exactly.
Yeah.
Thinking ahead about where price might go and figuring out your confidence level in that prediction.
And he notes that many traders just skip that part entirely.
Yeah. They're laser focused on the entry trigger, the stop loss placement.
But not the destination, not where the price is actually likely headed.
Correct. And missing that bigger picture, he implies, is why emotions can take over so easily. If you don't know where you're going, any path feels stressful.
That makes sense. Having potential targets, even rough ones, gives you a framework. It helps you judge if a small pullback is noise or something significant. Reduces the guesswork, maybe.
Reduces the emotional reaction to the noise, perhaps. Okay, now things get really interesting. He talks about losses.
The dreaded losses. What's his take? Avoid them at all costs.
Quite the opposite, actually. He frames them as necessary, essential even,
Essential. How so?
as learning tools. He says facing mistakes and losses is crucial for growth. It's how you identify your weaknesses.
Okay, so the insight is losses aren't failures, they're feedback.
Precisely. He uses this analogy about a new spouse.
Go on.
Well, imagine if your spouse never pointed out any of your flaws to avoid offending you. You'd never know what to work on, right?
Okay, I see the connection. The market's adversity, the losses.
They're like that spouse, highlighting the flaws in your approach, your understanding, forcing you to confront them.
That's a powerful reframing. A losing trade isn't a judgment, it's just data.
Valuable data for improvement. Now, building on that, he discusses what he terms the false romance of the market.
False romance.
Yeah.
That sounds intriguing. What does he mean?
It's this dangerous idea of seeking constant validation from the market, wanting it to always be easy, always give you wins, like it's a loving family member who is always nice to you.
But it's not, is it? He compares it to a dysfunctional element of family, I believe.
He does, and uses a, well, quite vivid analogy about the bed's open.
Right, suggesting that chasing those easy, quick hits without caution.
Can lead to STDs, financial losses, and ultimately a broken home, meaning a blown account or failed trading career.
Wow. So the core message there is, don't look to the market for constant affection or easy wins. Be realistic, detached even.
Yes, adopt a reasonable approach, he says, and know when to walk away. Turn off the charts if that relationship starts feeling unhealthy, too needy.
And that ability to step back, he suggests, comes from having a solid process, a rule-based system.
Exactly. He talks about breaking things down modularly. He mentions specific terms like top step and passing combine and getting payouts.
Which might refer to specific trading challenges or platforms, but the general idea.
Is about a structured, step-by-step progression. You demonstrate the logic of your trading through consistent rule application, not by getting lucky.
It's not about instant riches.
Definitely not. He even mentions wanting his son to succeed by applying these same methodical principles, but he's quick to manage expectations. Consistent weekly profits. Unlikely at the start.
It's about the learning curve, learning from wins and losses.
Which brings us neatly to managing your mental capital.
Ah, yes. Your focus, your emotional energy. What's the advice there?
On those days where it just feels like a grind, a struggle,
Yeah.
he says it's often better to just close out, turn off the screens, and disengage. Preserve that mental energy.
Don't burn yourself out fighting a market that isn't cooperating, or maybe fighting your own state of mind.
Right. He talks about that worry, the stress hormones, how he personally wore himself down early on by just obsessing over every tick.
It's a reminder that your mental state is a critical resource in trading. Maybe the critical resource.
And he highlights this trap. Traders who are making money but are miserable.
Profitable but unhappy. How does that happen?
Constantly chasing more. Never feeling like it's enough. Which leads right into the idea of contentment.
Which seems elusive in this field.
He flat out challenges the idea that more money automatically equals happiness or contentment in trading.
So where does contentment come from, according to him?
It's a mindset. Being satisfied with plenty, whatever that means for you, and crucially, not being driven by comparing yourself to others or needing external praise.
Which connect to being humble when you are successful.
Yes. He advises keeping wins quiet, recognizing everyone's on a different path, learning at a different pace.
And interestingly, he adds that seeing someone else struggle for a while can actually be reassuring.
Yeah, it normalizes the difficulty, makes people feel less alone in their own struggles.
Now, what about those early wins? The ones that give you that boost?
He acknowledges they're important. That warm, fuzzy stuff, he calls it, builds confidence.
Yeah.
But don't make that feeling the goal. True mastery, he argues, involves a certain indifference to the outcome of any single trade.
Indifference. How do you cultivate that?
Yeah.
Sounds difficult.
Through preparation, process, and rules. He envisions a trader who can spot good opportunities, but doesn't feel this compulsion to trade every single one.
They choose based on their analysis, their backtesting, their plan, not emotion.
Right. He uses the phrase Swiss timepiece precision to describe the potential outcome if you really internalize and replicate the rules consistently.
But again, emphasizes it's not quick or easy up front.
Absolutely not. It takes work to get there.
Right.
And when the plan doesn't work out, which it sometimes won't,
That's where risk management comes in. Defined risk management.
his specific approach, limit yourself. One trade a day, maybe. If it's a loser, you stop. That's it for the day.
A hard stop. That sounds disciplined.
It's designed to prevent tilt, greed, FOMO, all those emotional reactions that lead to bigger losses. He compares it to a regular job.
How so?
You do your assigned tasks for the day. You don't usually feel compelled to do 3 times the work just because you can. You do your job, then you go home.
That's a helpful way to frame it. Stick to the plan, control your exposure.
But he acknowledges how tough this is now with social media, constant updates.
Oh yeah, the pressure is immense. You see a setup, you take a loss, and immediately you want to jump back in, fix it.
He says that urge is counterproductive. Resisting it, stepping back, and actually observing what happens after your loss over time. That's where real learning happens.
Learning emotional regulation too, presumably.
Definitely. And he validates those feelings. Everyone has uncertainty, confusion, fear, anxiety, even in demo trading.
It's normal.
He says it's a normal physical response when you elevate the importance of the outcome too much, you're putting too much pressure on it.
Okay, so how do you break through the fear of trading real money then? If even demo causes anxiety.
His advice is maybe a bit surprising. Don't wait for the fear to vanish.
Just jump in.
Sort of. Start with the absolute smallest position size possible, micro lots, whatever it is, with a defined stop loss. Treat it like an icebreaker.
Ah, like just getting that first real trade done, regardless of outcome.
Exactly. Take the pressure off it needing to be a winner. He points out, a loss is just one transaction. It doesn't define you or your potential.
That seems practical. Lower the stakes dramatically to get over the initial hump.
Yeah. And he wraps things up with this core belief. that market behavior underneath the noise is actually quite predictable.
Predictable. How?
He talks about it being driven by an algorithm, which we can interpret as the collective behavior hunting liquidity,
Seeking out old highs, old lows, filling inefficiencies.
to ultimately offer fair value. The key, he stresses, isn't frantic trading, but dedicated study to understand these underlying principles.
So the path isn't necessarily more screen time, but more focused study time.
That seems to be the essence of it. Understand the why behind the moves.
Okay, let's try to pull the main threads together from this deep dive. What are the key takeaways for someone listening?
I'd say, number one, prioritize that foundational understanding over quick fixes. Really learn the market.
Number 2, actively manage your emotions. Understand they often come from discomfort with uncertainty and build tolerance for that.
3, embrace losses. See them as feedback, not failure. Essential for learning.
4, avoid that false romance. Don't seek constant validation from the market. Keep it rational.
And 5, recognize it's a gradual journey. Consistency comes from rules, process, and really disciplined risk management. It takes time.
That covers a lot of ground on the mental game.
It really does. So for you, the listener, here's a final thought to chew on. Take a moment and reflect. Is any part of how you're currently learning about or trading the markets driven by that false romance this speaker talked about? That craving for easy, constant wins?
And if so, what's one small, concrete, rule-based step you could introduce right now today, even to cultivate a more objective, healthier perspective?
Think about it. How might shifting your focus away from just the immediate profit or loss toward building that deep, long-term understanding actually change your entire experience with the markets?